Okay, let's unpack this because usually when we sit down to do a deep dive, we're looking at history, in the rearview mirror.
Analyzing something that's already happened, yeah.
Exactly. We're trying to figure out why it happened. But today feels different. We're looking at a stack of reports, financial data, diplomatic cables, and they're all pointing forward to a very specific date, February 2, 2026.
It's a date that the sources are really framing as a turning point, a fulcrum.
A fulcrum, that's a great word. And if you're picturing, the end of the world order with tanks rolling across a border or some big dramatic speech, the picture these sources are painting is completely different.
It's much quieter.
It's quieter, it's bureaucratic, but honestly, it might be scarier because of that. The term they keep using is the rupture.
And the rupture is the perfect word for it, really. It implies a breaking apart, a snapping of bonds that held everything together for so long. We're essentially decoding how the global order isn't being dismantled by missiles, but by wire transfers.
By wire transfers and trade agreements. We're talking about the end of the unipolar world, the era where the U.S. calls the shots. And the catalyst isn't a lost battle, it's a lost balance sheet. So the mission for this deep dive is to understand how financial assets have, transformed into weapons of war.
I think we all need to shift our mindset from what we call kinetic warfare.
Guns and bombs.
Exactly, the stuff we see on the news. We need to shift to capital warfare because the battlefield in 2026 is the bond market. The ammunition is debt, and the stakes. The stakes are nothing less than the American standard of living.
So let's start with that ammunition. We have to talk about the number that is just looming over every single page of this research. It's the elephant in the room, but the elephant has gotten so big, it's crushing the building.
It is. The U.S. national debt has hit $38 trillion.
$38 trillion.
It's a staggering figure. I think for a long time people heard trillion and their eyes just glazed over. It just sounds like a lot. But we've passed the point of a lot, and we've entered the realm of a systemic threat.
To make that real for you listening, I did some quick math on this based on the census data in the report. That $38 trillion, it breaks down to over $110,000 for every single person in the U.S.
Every man, woman, and child.
Every single one. So if you're a family of 4, congrats, you have a nearly $500,000 debt hanging over your head that you never even signed for.
And that's just the principle. That's the sticker price. The real danger, the thing that actually triggers this capital warfare, is the cost of carrying that debt. This is the real aha moment in the data.
The interest payments.
The interest. The U.S. government is now spending approximately $1 trillion a year just on interest.
Hold on, let's just pause there. $1 trillion a year just to pay the interest. That's not fixing bridges, it's not paying soldiers, it's not health care.
It's the minimum payment on a national credit card.
Wow.
And here's a comparison that should make the hair on the back of your neck stand up. That figure, that $1 trillion in interest, now surpasses the entire U.S. military budget.
So we are officially spending more to service the financial mistakes of the past than we are on the actual defense of the present.
That is the textbook definition of a crumbling empire, historically speaking. When your past obligations start to outweigh your current capabilities, you become vulnerable. And this vulnerability is exactly what's being weaponized.
How so?
For decades, the U.S. Treasury market was the bedrock of global finance. It was the risk-free asset. But when you're borrowing just to pay interest on what you've already borrowed, the world starts to look at you a little differently. The trust starts to erode.
And this is where the warfare part kicks in, right?
Right.
Because if the world stops trusting the bank, they stop keeping their money there.
China's been the vanguard on this. The data is pretty clear. Since 2021, Beijing has sold off over $340 billion in U.S. bonds. That is a massive liquidation.
Okay, but let me play devil's advocate here. China's a rival. We're in a trade war, a tech war. Of course they're going to dump our debt. If I were Beijing, that's exactly the lever I'd pull to squeeze Washington.
That's true. And if it were just China, the U.S. Federal Reserve could probably manage it. They could absorb that kind of blow. But here's the twist in the narrative, and this is what makes the rupture so dangerous.
It's not just the rivals.
It's not just the rivals.
Yeah.
It's the allies.
This was the part of the research that really floored me. We're seeing Western institutions, our friends, heading for the exits.
Look at the Danish pension fund mentioned in the report. This isn't some rogue trader. It's a prominent, conservative, Western institutional investor. And they have fully divested from U.S. treasuries.
And pension funds aren't day traders. They think in 30-year horizons.
Exactly. For a Danish pension fund to say the U.S. government debt is too risky for us, That is a massive vote of no confidence.
And we're seeing European hedge funds dumping U.S. stocks, too. It feels like the smart money in Europe is just quietly backing away from the table.
That is the rupture. It's when that unspoken agreement that the West sticks together financially finally breaks down. And the nightmare scenario described here, the thing that keeps central bankers up at night, is cascade.
A domino effect.
A domino effect. If major holders like Japan or, Canada see this trend and decide they need to trim their exposure to protect their own currencies, you get a rush for the door.
And if everyone tries to sell U.S. debt at the same time,
Bond prices crash. And yields, which are just the interest rates the U.S. has to pay to borrow money, they spike. And we aren't talking about a quarter-point hike from the Fed. We're talking about a spike that could trigger a global financial crisis that would make 2008 look like a minor correction.
So the financial foundation is cracking. This capital warfare is undermining the dollar. But while Washington's trying to plug those holes, there's a whole other game being played on the diplomatic stage. The report calls it the Great Pivot.
Right. And this is where we move from the abstract numbers to real people, real handshakes, and, well, real consequences. The contrast in the source material is stark. You have the U.S., which is seen as looking inward, threatening tariffs, being unpredictable.
And then you have the rest of the world engaging in what they call a silent migration of power.
Toward the east, yes. I mean, look at the timeline. It's wild. In January 2026 alone, last month in this scenario, 6 of America's closest allies sent their leaders to Beijing.
6 leaders in 30 days. That's a diplomatic stampede.
It's not just checking in. That's paying homage to the new center of gravity.
And the one we have to zoom in on is the UK. I mean, the special relationship between the US and the UK is legendary. But looking at the deals Prime Minister Keir Starmer just signed in Beijing, it looks like the special relationship is filing for divorce.
Or at least an open marriage. Let's be real about the UK economy. It needs growth, it needs investment, and right now, the US is offering America first. China is offering global trade.
So Starmer didn't just go for tea.
He came back with a multi-billion-pound agreement that basically integrates the UK economy directly with China's.
Let's break down the specifics because they are fascinating. First up, the auto industry.
A huge deal. The Chinese automaker Chery is establishing its European headquarters in Liverpool. Just think about the symbolism of that.
Liverpool, an engine of the British Industrial Revolution.
Now, hosting the flagship of Chinese industrial might, that brings jobs, sure, but it anchors the entire UK auto supply chain to China.
And then there's the pharma deal, AstraZeneca.
This one is even more telling. AstraZeneca signed an $18.5 billion deal for Chinese pharmaceutical licenses. Now, stop and think about the direction of that money. For a century, the West was the innovator. The East was the manufacturer.
We designed it, they built it.
Exactly. This deal flips the script. A top-tier British company is paying billions to access Chinese innovation, Chinese intellectual property.
That really drives home the point that China isn't just a factory anymore. And to sweeten the whole deal, China played the good guy card perfectly.
They did. They offered a 50% tariff reduction on British whiskey.
I'm sure that made for some very happy toasts in Scotland.
I'm sure it did. But even more importantly, they offered visa-free travel for UK nationals. That is a huge cultural signal. It says, we trust you, we are open, come on over.
It's a complete narrative flip. The sources contrast this with the U.S. approach. You have a Chinese vice premier talking about dialogue and building bridges, while the U.S. is talking about sanctions and walls.
There's a quote in here from an international relations expert, Victor Gao, that just nails it. He says China is no longer just a rival. He calls it a megatrend.
A megatrend. That sounds like something you can't stop.
That's his point. You can't sanction gravity. You can't tariff the tide. Nations feel they have to collaborate if they want to survive in the industries that will define the future. AI, EVs, green energy. If you cut yourself off from the megatrend, you aren't hurting China, you're just making yourself obsolete.
So we got money fleeing the U.S. debt market. We have allies pivoting to Chinese trade deals. But there's a third layer to this rupture that feels much more physical, more tangible.
Not resource war.
The resource war.
This is the bedrock of the 2026 economy. We can talk about digital currencies and stocks all day, but at the end of the day, you need actual stuff to build stuff. And the stats on China's dominance in critical minerals are, well, they're just overwhelming.
It's a chokehold on the periodic table.
Effectively, yeah. China processes roughly 90% of the world's rare earth minerals. They control 60 to 70% of global lithium refining.
So if you want to build an EV battery for your climate goals or a guidance chip for a missile for your defense goals, you're dependent on Beijing.
You are. And for a few years, the buzzword in Washington and Brussels was decoupling. You know, the idea was we'll just find it somewhere else, we'll build our own supply chain.
Right.
But the source material gives us a brutal reality check on that idea with the molybdenum shock.
Molybdenum. I have to admit, before I read this, I couldn't have picked molybdenum out of a lineup, but it turns out modern civilization kind of depends on it.
It does. It's essential for high-strength steel. You need it for defense armor, for pipeline skyscrapers. It makes steel tough enough to survive.
And what happened in 2025?
Beijing decided to demonstrate their leverage. They brought in strict export controls, and in a single year, they slashed exports of molybdenum by over 95%.
95%. That's not a reduction, that's a blockade.
It's a shutoff valve. And the consequence was immediate chaos in Western industrial sectors. Corporations were scrambling to find alternative supplies in, Canada or South America. But here's the problem with decoupling. You can't build a mine in a year.
It takes a decade.
It takes a decade just to permit and develop these resources. So while we're drawing up plans for mines that might open in 2035, China turns off the tap in 2026. This is the stick that pairs with the carrot of those trade deals.
Okay, let's zoom out and look at the whole board. The U.S. financial system is shaking. The allies are hedging their bets and pivoting to China. The supply chain for the most critical materials on Earth is controlled by the very power the U.S. is trying to contain. So if I'm an investor or just a regular person trying to protect my savings, where do I go?
That is the question driving the markets in these reports. The sources all call it the flight to hard assets.
Because if the dollar isn't the safe haven and the debt markets are being used as weapons, what's left?
The answer, increasingly, is gold. Hard, physical assets that have no counterparty risk.
The forecasts here are incredibly aggressive. We're seeing predictions from global banks. We're talking giants like HSBC and JP Morgan saying gold will hit $5,000 an ounce by the end of 2026.
And just to put that in context, that is massive repricing. Gold at $5,000 isn't about jewelry. It isn't about industry. Gold is a fear gauge.
It's a vote of no confidence.
It's a vote of no confidence in this system, specifically in the U.S. dollar's reputation for predictability. The dollar has been the world reserve currency because it was stable. But a nation with $38 trillion in debt and political gridlock? That isn't stable. So the money moves to the one thing that politicians can't print more of.
And we're seeing copper and silver hitting all-time highs, too.
Right. Which tells us this is a broad flight to real things. The world is hedging against the instability of the paper system by buying the physical system.
So let's try to synthesize this. We started with the rupture. What does the world look like on the other side of it?
It looks like the definitive end of the unipolar moment. We aren't just drifting away from American dominance. We are seeing the structure of a new, multipolar world being built in real time.
And the rules of this new world are different.
Completely different. Power is no longer just about who has the most aircraft carriers. It's defined by financial leverage, who holds the debt, and mineral control, who holds the dirt.
The U.S. is trading on a reputation that's fading, while allies like the U.K. are making a cold, hard calculation.
They're trading American military protection for Chinese economic survival.
That's a profound shift. It's not ideological, it's just survival.
It's pragmatism.
Yeah.
And, frankly, it's inevitable when you look at the math we started with.
As we wrap up this deep dive, I want to leave you, our listener, with one last thought. We've thrown a lot of huge numbers around. Trillions of dollars, billions in trade. But there's a very human question at the bottom of all this.
What's that?
If the U.S. dollar loses its status, if the world stops subsidizing our debt because they don't trust us anymore, and if the safe haven is gone, what happens to the standard of living for the average American family? We have relied on cheap imports and a strong dollar for 40 years to subsidize our lifestyle.
That is the ultimate provocative question. Because if the dollar weakens significantly from this, the discount window closes. The cost of everything, your phone, your clothes, your gas, it all goes up. The rupture might start in the bond markets, but it ends at the kitchen table.
It's a heavy thought, but I think it's better to see it coming than to be blindsided.
Absolutely. Understanding the shift is the first step to navigating it.
Well, that's the rupture. A lot to chew on. Thanks for helping us decode the signal from the noise.
My pleasure.
And to you listening, keep watching the numbers. We'll catch you on the next deep